Welcome to Commodity Flux, the podcast where we track the trends, turns, and turbulence shaping global markets. Today, we're dissecting the latest volatility in the Chinese steel market, a sector in flux amid U.S. tariff shocks, shifting fundamentals, and a rapidly evolving trade policy timeline. Let's get right into it. First, the market pulse. China's steel sector is under mounting pressure. Last week, apparent consumption of the five major steel products dropped by 197,000 tons. Construction steel saw a brief seasonal uptick. But let's put that in context. March is the month when construction steel demand usually peaks, so this rebound may be short-lived. Meanwhile, industrial steel demand is faltering. Hot-rolled coil consumption, vital for autos and machinery, dropped by 170,000 tons last week. Cold-rolled sheet and medium-thick plate also declined, reflecting broader weakness in manufacturing sectors. Automotive sales rose 12% year-on-year in March, but the growth is slowing down. Home appliances, construction machinery, and steel structure companies are feeling the squeeze, with cash flow tightening and export prospects clouded by tariff risk. Despite weak demand, steel inventories are down 4.72 million tons year-on-year, and steel mills are still profitable, earning 100 to 300 yuan per ton. Blast furnace operating rates remain high, and daily iron ore demand is steady at 2.4 million tons. But the overall trend is bearish, with price volatility set to continue as fundamentals deteriorate. Now, the tariff timeline. This is where the flux really shows. April 2nd, President Trump declares Liberation Day, imposing a 34% reciprocal tariff on all Chinese imports, on top of an existing 20%, raising the effective rate to 54%. April 4th, China retaliates with a 34% tariff on U.S. goods and launches export controls on rare earths. April 9th, the U.S. hikes tariffs again, bringing the total on Chinese goods to 145%, a 125% reciprocal tariff plus the earlier 20%. China matches with its own 125% rate, effective April 12th, and signals it won't respond to further U.S. hikes. April 10th, the White House announces a 90-day pause on new tariffs for most countries, but not China. The hardline stance remains, and the market reacts with a global sell-off. April 11th. In a late-night move, the U.S. issues a crucial exemption list. Smartphones, computers, semiconductors, flat panel displays, and other key electronics are now excluded from the reciprocal tariffs, retroactive to April 5th. Importers can seek refunds for duties already paid. This is a major relief for tech supply chains and companies like Apple and Dell. But the 20% fentanyl-linked tariff on all Chinese goods remains. What does this mean for steel and broader trade flows? About half of China's exports to the U.S. are machinery, equipment, home appliances, and vehicles. Over 14 million tons of indirect steel exports are now at risk. But the share of indirect steel exports to the U.S. is declining down to just over 8% in early 2025. Finished steel products constituted the largest category of China's indirect steel exports, representing 38.3% of the total, followed by automobiles, machinery, and ships. China's indirect steel exports to the U.S. rose 12.8% year-on-year in early 2025, among which finished steel products and autos fell while ship grew. Notably, nuclear reactors, boilers, machinery, and mechanical appliances represented the largest category in 2024's indirect steel exports to U.S. They dominate in export value terms of nearly 70%, despite a smaller share of about 29% among total indirect steel exports to U.S. The tech exemption is a lifeline for electronics, but for steel, the environment remains hostile. China's response focuses on domestic demand stimulus and market diversification, but the near-term outlook is volatile. Takeaways. Watch the 90-day window and the evolving exemption list. Policy flux is the new normal. Tech supply chains get a reprieve, but steel and heavy industry remain exposed. Short-term, tight inventories and steel mills' profits could support prices, but the medium-term trend is down unless demand rebounds or policy shifts again. For more information, stay tuned to Commodity Flux, where we help you navigate the dynamics and constant change of commodity markets with a deep dive into China.